Hey guys, this is part two of the prior video I did on a TY3 cycle trade with SFLY. And this particular one, I'm going to show you how I cut the risk way down on the trade. Again, this is a trade that I started out with about $158 in, and it popped up very nicely over a few days' time. And on the pullback, just because I didn't know how deep the pullback was, I actually had enough time on this option for it to go out another month before expiration and get a pretty nice gain over the course of about 2 months in the trade. Yeah, a month and a half, 2 months, yeah, about a month and a half. And but what I did was, because you never know how deep that pullback is, this particular stock had a almost, let me just look at the lows on this consolidation. Broke out around 40 bucks, went to 75 bucks. It was up about 100% almost. At the point it was going to pull back in the consolidation zone. Sometimes those consolidation zones can go out a month and a half before you actually get the follow through. And not knowing which or how much time in that consolidation zone it was going to spend, what I ended up doing was selling after about 3 days up after the breakout. Generally get quick 3 day cycle on earnings breakout, and then you get a couple days of backfilling, etc. at least. And so what I did was I sold out of the very low priced call options I had. Again, I'm going to show you the breakdown here in a minute, but I wanted to just give you the big picture on it. And what I did was I got back in on a deep in the money option. Basically cut the risk way down. Only bought 5 contracts. I had the overall risk down to about $500 on the remaining balance. So I went from 158 bucks to $6,800 on the trade. And on the pullback, I bought back in. I've only bought 5 contracts because I don't want to risk more than 500 bucks of the prior money I made. So I got back in the trade, risking 500 bucks, and I turned that about 1,000 bucks into about I believe it was around 4,000 plus. I'll look at the numbers here in a minute, but let me just go ahead and show you the breakdown, what my thoughts were on the trade, so you can see. Again, when you get a real big gain on a stock and you want to conserve the profits, you don't want to give it back again, but you also want to maybe milk the trade a little bit more. This is a way to do it where I cut the risk down on the trade down to 500 bucks. If it was a deeper pullback, that risk could have been a lot more than that if I had kept the prior options. So this was a way also to milk the trade without having to give back much if it was a deep pullback. So let me go ahead and show you the chart again and break it down a little bit further. Okay, just to refresh your memory on this particular trade, started out with 158 bucks down here, buying way out of the money option, $60 calls, just because we had a breakout of a TY3 cycle. So what I did was ended up making about 4,100% on this particular first part of this trade, and then waited for the pullback. So what I did was actually I got out on day 3 of the breakout, very close to the close of the day, and expecting that we would get a soft landing pullback, but I was prepared for a deeper, longer retracement. Originally bought some March calls, and in hindsight, keeping the March calls would have worked out very well. But I wanted to cut the risk down because a lot of times when you get a big gain, this is already up close to 100%, very close to 100% out of the base, and sometimes you'll get 4 to 6 weeks sideways before you get to push to the next wave. And so what I didn't want to do was have this be a deep retrace and get back half of what I originally made. You know, if you get down to 62 or 63 bucks, you're only 2 to 3 bucks in the money versus being, close to $15 in the money on your calls. So my strategy was to cut the risk, but also milk the trade a little bit more. So what I did was I bought, let me just show you the breakdown here, pause this. So to look again at the original trade, again, I bought 5 contracts, 31 cents, which is $31 per 100 shares, 158 bucks in. On the first part of the trade, made $6,800 or 4,130% gain. Let me show you part 2. So part two here. I had bought 72.50, slightly out of the money. I think I had mentioned I had bought deep in the money. I confused this with another trade, but this is slightly out of the money. The price at the time was around 71.50 when it broke out. So I just was about $1 out of the money on this particular call. So what I did was I bought 4 contracts. Total cost was $906 for the 4 contracts. And so basically, in my head, I was risking half of that. So originally made it $6,800. I was only willing to give back $500 in part two in case I had the timing off. So this was a way to cut down that original risk of that original trade in case we had a deep retracement. Could have been a 50% retracement in the account proceeds from that particular trade if it was a deep pullback. Again, I was at a $60 strike price on that. So what I did was, again, got out of the original trade, locked in that profit, and I was willing to risk half of that 906, about $450, and still milk the rest of the trade. So what happened was over the next month it went up to where it went to 5,073. So it was about a 459% gain on this $906. So about a 4,166. Adding that to the original amount. Let's pause that again here. So the $6,800 on the original trade added to the proceeds from this particular one, actually the gain right here. So total was $10,849, or a 6,800% gain on that $158 investment. Okay, that about wraps it up. I hope you enjoyed the video, and if you'd like to be notified when we post more of these videos on the channel, just hit subscribe and also the bell icon to be alerted immediately when we post a new video. Have a great day. Take care.